Okay, this section is 14B about sales variances and operating statements. We have sales volume variance and sales price variance. We'll discuss as we do questions again. Let's see question 14B1 in your kit. The first question, it says a company currently uses a standard absorption costing system. The fixed overhead variances extracted from the operating statement for November are fixed production overhead expenditure variance 5,800 adverse, fixed production overhead capacity variance is 4,200 favorable, and fixed overhead efficiency variance is 1,400 adverse. P company is considering using standard marginal costing. So they actually are they use absorption, but now they are considering using marginal costing as the basis for variance reporting. What variance for fixed production overhead would be shown in a marginal costing operating statement for November? Now, you don't need to make any calculations. You should remember that in absorption costing, your fixed overhead variances can be volume related or efficiency related. But in marginal costing statement, we don't talk about how much you produce, how much you sold, if you produce more, if you produce less. Those things we do in absorption costing. In marginal costing, whatever your total fixed overhead you incur, you write down the total fixed overhead into your statement. You don't make absorption into the units, and you don't have under absorption and over absorption. So because you are using now, considering to use marginal costing, you should only see this is your answer, 5,800 adverse. Forget about this capacity thing and efficiency thing. They are related to absorption costing. In marginal costing, when I say 5,800 adverse, you know what it looks like to me? It looks like to me, for example, that their budgeted fixed overhead, let's suppose, was 10,000, and their actual fixed overhead is 15,800. I'm just supposing numbers, and therefore you have 5,800 adverse. So in marginal costing, you straight away write down 15,800 in your statement. That's all. So 500 is the fixed overhead adverse variance. Your answer option should be here, B, expenditure variance of 5,800 adverse. You don't talk about capacity and efficiency. Capacity, efficiency, they go in absorption costing. If you produce more, you produce less, you come under absorption, you do over absorption. They don't happen in marginal. In marginal, you just write down the straight away fixed amount. So 14B, one answer should be B option, 5,800 adverse. Then we move to 14B2. It says, which of the following situations is most likely to result in a favorable selling price variance? Favorable selling price variance. Number one, the sales director decided to change from the planned policy of market skimming pricing to one of marketing penetration pricing. Okay, so result in favorable selling price variance. No, this will not. Because in market skimming, you are moving from skimming to penetration. You should remember that market skimming means higher prices, and market penetration, it means lower prices. So you actually, when you are moving from skimming to penetration, you are decreasing the prices. You have decided to decrease the price. So if you are decreasing prices, you cannot have favorable selling price variance. Actually, this strategy will give adverse selling price variance. A is not the answer. B, fewer customers than expected took advantage of the early payment discounts offered. This also is not the answer, because if less customers are taking the advantage, it's not going to make any selling price variable. It is about, payments and discounts. Goods have already been sold. You are not changed the selling price. Selling price was not there because goods were already sold. Now this is an additional discount on receivables which you give, and it will only be shown in cost of sales, or it will be shown in your admin expenses. When you give discount to customers, your sales are not affected because they have already been sold. So it will have no consequence on selling price variance, either favorable or adverse. Absolutely, it is not related. C, competitors charged lower prices than expected. Therefore, selling prices had to be reduced in order to compete effectively. So again, you are decreasing the selling price. If you decrease the selling price, you cannot get favorable selling price. Favorable selling price variance means that you charged more. Favorable selling price means that your sales prices increased. But in this case, it is decreasing. So this is also exactly opposite. It will make adverse selling price variance. Demand for the product was higher than expected, and prices could be raised without adverse effect on sales volume. This is your answer, because you are increasing the prices without affecting the sales volume. In any case, your sales prices are more. This is your selling price favorable variance. So this was explanation to 14b2. 14b7, what was the actual number of units produced? Actual number of units produced. A company uses a standard absorption costing system. The following details have been extracted from its budget for April. Fixed production overhead cost 48,000. Production units 4,800. So this is your budget. And we are talking about, so your budgeted production was 4,800 units. You plan to make 4,800, but they ask you how much did you make. In April, the fixed production overhead cost was under absorbed by $8,000, and the fixed production overhead expenditure variance was 2,000 adverse. So fixed production overhead cost was under absorbed by 8,000, and the fixed production expenditure variance was 2,000 adverse. Based on this, you need to calculate how many units you produced. Okay, let's do it together. So it's simple. Again, it is not something with the sales variance. It's again fixed overhead variance. They have put it in the sales variance section. You have your, budgeted fixed overhead, which is, we know that they gave us 48,000. And then they told us that budgeted activity was 4,800 units. So this is like your USD, this is your units, okay? So you can say that your OAR should be 48,000 divided by 4,800. So your OAR is $10, okay? You can call it, USD 10 per unit. So your fixed overhead absorption rate is $10 per unit. Now, our budgeted overheads, again, I will say that budgeted overheads are 48,000. Let me write down, copy paste it here. And we have here an, it says that fixed production overhead expenditure variance. Your expenditure variance is 2,000. Expenditure variance is 2,000 adverse. Variance is adverse. Adverse means that you spent more. So you actually spent 50,000. So your actual expenditure because budget was 48 and it said that you had 2,000 adverse variance, which means you spent more. So actual expenditure is 50,000. But then they also tell you that your fixed production overhead cost was under absorbed by 8,000, under absorbed. So this is what you actually spent. Now, how much you absorbed? So I need to calculate my absorbed overheads. My absorbed overheads will be 50,000 minus 8,000. because it said that absorbed overheads were less. There was an under absorption. Under absorption means that you absorbed less. So it means that your absorbed overheads are 42,000. And what is the rate at which you were absorbing? You were absorbing at $10 because this was your standard rate. You totally absorbed $42,000, and $42,000 which you absorbed them on the base of $10 per unit. So how many units were there? Then you say that units, because units produced would be, you divide them 42,000 divided by 10. 42,000 divided by 10. So which makes you 42,000 divided by 10, 4,200 is your actual production. So you actually produce only 4,200 units. You should remember that your absorbed overhead formula. What was absorbed overhead formula? Absorbed overhead formula was, absorbed overhead was equal to actual quantity multiplied by
times, yes.
Oh yeah. So absorbed overheads, I know. I can calculate my absorbed overheads 42,000 is equal to actual quantity. I do not know. It is X multiplied by 10. And that's how you can say that X is equal to 42,000 divided by 10, which means that X is equal to 4,200. So that's pretty simple, just a little bit of mathematics or whatever you may call it. But this question is not from sales variance. Unfortunately, they put it in the sales variance section, but that's typically, not a sales variance question.